Welcome to Real Estate Talk, part of the Realty Media Group. We also produce The Property Show, Real Estate Uncut and CoreLogic's auction updates. All available for catch-up anytime at realty.com.au. Before we get underway, thanks to BMT Tax Depreciation, Printforce and Propertyology for their support. Hello and welcome to the show. Pitch it low and watch it go, or pitch it high and watch it die. The language used by agents when it comes to pricing a property. Agents are forever being accused of underquoting. Pitch it low and watch it go. That's what they say. And every state and territory has laws that are supposed to prevent it. In Queensland, the state government has passed a law that prevents agents from giving an indication or a price range on a property at all if it's going to auction. Veronica Meighan is Sydney-based, and she and Meighan Wells from Brisbane, both buyers agents, discuss the merits of price guides today in the show. Veronica and Meighan also discuss the best and quickest path to researching a market so as you become an expert in a particular segment. Veronica then catches up with Eliza Owen about the impact of the federal government's decision to direct money towards the construction industry via first home buyers in an effort to stimulate the economy. Is it a good thing? Is it good for the long term, or is it good for the short term? We'll find out. Brad Beard joins me to talk depreciation, and Veronica and Meighan share their buyers agents' experiences in helping their clients set bidding and price limits on properties that they want to buy. But first, here they are talking about underquoting by agents. So strap yourself in.
Well, we're back. Kevin's still away, and Meighan Wells and I, Veronica Meighan, we hold the chair. So if you don't know who we
what are we talking about this week?
We are going to talk about price guides, understanding them. Also, we're going to talk about researching property prices and setting your limit when you're buying a property. So that's the three segments that we're going to host this. We are co-founders of Home Buyer Academy, your first home buyer guide. We're passionate about helping first home buyers. So let's kick off with price guides. Agents are forever being accused of underquoting, and in every state and territory has laws that are supposed to prevent it. The most extreme being in Queensland, where it's actually against the law for an agent to give a price guide. Meighan, how do agents go about getting the right buyers in the door?
It's really interesting, Veronica. This law came in 2014 when the new Act came in. So they repealed the Property Agents Motor Dealers Act and brought in the Property Occupations Act. And one of the things they really wanted to stamp out was any agent underquoting a property. So they took to the problem. You know, I think the thing that I kept saying at the time was they used a cricket bat to spot a fly. So it wasn't that big a problem. But what they did was took away the agent's ability to do any kind of price indication if the property was marketed without a price. So if it's got a price on it, that's fine. But if it is for sale by negotiation or public auction, agents can't give any kind of price guide. All they can do is give comparable sales. So agents will use that methodology and point buyers to recent sales of properties that are at the low end of where they think the property might go, and that helps them generate interest and a bit of excitement around the property.
So it's sort of same thing, just a slightly different execution, because obviously in other states where there are laws you are able to quote, but there are requirements in terms of justifying the price guide that you give to your owner so that you are telling supposedly the buyer and the owner or the seller the same story, right? So, and obviously...
Yeah, so in New South Wales, Veronica, I'm really interested in how you explain this, but in New South Wales, and I think Victoria as well, it is very prescriptive, and agents can't underquote. So how do they come up with the quoting range? And can buyers rely on that quoting range?
Well, the answer is no to that one, but I'll explain why. I mean, excuse me. Obviously, the law is different in both states, but is somewhat similar in its general execution, and that is an agent has to justify a price that they're giving to the vendor and ergo to the buyers, and so they will justify that by looking at comparable sales. So that process this is somewhat simple. They will err on the low side of that if they can get away with it. But every agent has to walk this fine line between what does the owner want, and not insulting an owner who wants a high price for their property, and actually sort of getting the listing by sounding like they're confident about the property and they're going to get the price. And then obviously making sure that they can quote it low enough so that buyers will actually be attracted to the property and they generate enough interest to actually get a good auction off the ground. So
there's a saying that you have. Tell us the saying that applies in this instance.
And it's not just me. This is an industry saying. It's quoted.
It is an industry-wide one, yeah.
Quote it low, watch it go. Quote it high, watch it die. And certainly when I was a sales agent, we used to quote that, and we used to try to explain to owners why we needed to quote it as low as possible, because buyers will come along and if they add a blanket, say 10% or $100,000 to any agent's guide, they're going to get it wrong, because some agents will quote closer to the real price and others will quote further away. And so there's no blanket way that agents actually treat price guides. So therefore buyers have to actually understand themselves what the value is before they can make a decision on price.
That's hard, isn't it? As a buyer, it's really hard to probably interpret what information they're receiving.
Well, it is, but I remember very keenly on the sales side as well. You've got to, there's another saying, buyers are liars. I'm sure you're familiar with that one.
Heard that one many times.
What buyer tells an owner or tells the seller, the agent, exactly how much money they think it's worth and how much they're prepared to pay for it? Do you?
Yeah, and well, never, but not until it's on an offer. But I think the other thing is that what I've come to learn over the years is buyers often don't know what they don't know until they're forced. Often like a seller doesn't really know what they would accept and what settlement terms they want until they're actually forced into that decision-making mode. Yeah. And buyers often, will say, well, it has to have this in this area and these features, and, I definitely have to have a pool. And they buy something in a different area with different features and no pool. And the agents feel quite affronted by that because,
yes.
Buyers are liars. Well, they found something they liked better than they thought.
It's so true. We will be back shortly because we are going to talk about that exactly. We're going to talk about how to set your limit. But before that, even, we're going to talk about how to research prices so that you really do have a clear understanding of where any particular property sits in terms of value relating to others in the area. So, and also you and I, we did create a course on this, a little mini course on this, which we'll give details on shortly.
A free mini course, no less. But I think there's also a very good chapter in your book, Veronica, that talks about price guides and so forth.
There is, and I should have a copy of it right here to hold up, shouldn't I? I'll go and grab one for when we come back.
I normally have one right here. See you shortly.
Successful property investors know the value of leverage, but as many as 80% are willing to leave sometimes thousands of dollars of unclaimed benefits on the table every year by overlooking depreciation. Depreciation is the wear and tear of a building and its plant and equipment. The ATO allows the owners of any income-producing property to claim depreciation as a deduction, meaning you will pay less tax. BMT's fee is 100% tax deductible. Call BMT Tax Depreciation on 1300 728 726 now for a free assessment of your likely deductions. That's 1300 728 726 or use the link at Real Estate Talk.
Okay, back now to Veronica and Meighan as they move into the area of free valuation reports and just how reliable they are or how reliable they're not.
Well, we're back with the copy of the book.
Oh, you got the book. Brilliant.
I'll even give you a discount. So if you're watching this and you'd like to actually get a copy, I'll give you 30% off plus free postage. That's a pretty good deal. You just have to go to getauctionready.com.au and the code to put in there at checkout is RETalk. Okay, RETalk, 30% off plus free postage, auction ready. Right, Meighan, you and I.
It's a good read, full of absolute nuggets of gold.
Well, thank you. Now, Meighan, you and I have created a free mini course, which we just mentioned a bit earlier as well, to teach buyers how to actually to research property prices. And also in our research, we discovered how inaccurate those free reports are that banks and mortgage brokers hand out to their customers. Now, what were you most shocked by when we did that research?
I think it really showed how much it's throwing darts at a dartboard with your eyes covered when you use those auto vals or property reports. And we know that the people that are providing them are just trying to help. They're trying to help, but they're outside their area of expertise. And the thing that shocked me most when you and I did this exercise was we did 10 free property vals or auto vals or property reports. We did 10 from 10 different banks and brokers and so forth. And just to give you the context, the property sold for $740,000. The range of price indication on the 10 auto vals, the range was $299,000. Two of the auto vals didn't actually have the sale price within their range, their recommended range for the property. So someone may well have paid, if they were using that particular auto val, they may have paid well over what the property was worth based on the information provided in that auto val. So that to me was an absolute eye-opener, that there is no accounting for that personal in-depth research that you've got to do and have your feet on the ground. And that's what that mini course, with a free mini course that we created, is all about, is stripping back and really getting in-depth, intimate with the properties that are around, so that when you do find a property, you know how to use comparable sales to arrive at a reasonable assessment of what the property's worth today.
That was, yeah, I was about to say, it's fundamentally, it goes back to both you and I being sales agents many, many years ago before we became buyers agents. So, and you learn how to appraise a property properly. If you're in a reputable agency that actually doesn't just press a button, you know, in RP Data or CoreLogic, you do actually have to go in and interpret those properties, because those ranges that are created by a computer, well, as we all know, you can walk into every house in one street and they're all different, you know, unless you're looking at cookie cutter sort of little boxes on the hillside in outer areas where they're all exactly the same and they're only a few years old. In those inner city suburbs, there's a lot of variety. And so understanding the detail and what properties are attractive to buyers and what aren't attractive to buyers, and what people will pay more for versus what they will pay less for. That's fascinating, but those AVMs can't look inside and see whether it's renovated or to what standard.
No, or what the natural light is like, or what the room sizes are like, or the flow, or the bones, the finishes, the features. You know, is there a large enough wardrobe space for the main bedroom? These are all things that affect price, and auto vals can't actually do that. But you and I both believe very strongly that there's no substitute for market knowledge, and a smart buyer really needs to become an expert in their particular segment. What do you think is the quickest path for a buyer to take?
Well, you do have to get out there and look. I think, first of all, you know, we advocate it too, that get online and actually have a look at what has sold. So many buyers actually don't do that. They look at what's currently on the market. And so then they're sort of tracking it as time goes by, as opposed to having a look at, say, the last 3 months and really getting a sense of where were prices sitting, then going out.
And you can get that free, can't you? You can actually access that information free online on realestate.com through the sold tab.
Yeah,
we were quite surprised at the number of people who didn't know that information existed and was freely available. But it's a really good place to start gathering your knowledge about what things are selling for.
I think too, a spreadsheet is really important, because it can get overwhelming and confusing, and you think, oh my God, and things like land size, things like aspect, things like, you know, the renovation standard and date, and things like, you know, the characteristics or the architectural characteristics of a property. And there's just so many things that can get into be a real blur when you look at lots and lots of properties. It all becomes really fuzzy, and a lot of buyers get overwhelmed and confused. And often, so I've heard people say they go to a property after they've even bought it and they can't remember the detail of it. What they bought.
Yeah. So true. That's why we take about 100 photos whenever we go through a property for a client, because there's just no way you can organise your thoughts systematically unless you have some sort of process, a spreadsheet, good photos, notes on floor plans, you know, that systematic approach to making sure that you really know what you're looking at, and then can look back. When you find something you like, you can look back on those notes on that spreadsheet and say, okay, well, I remember going through that one in Smith Street. and it sold for X dollars. This is a bit superior. Yeah, probably a little bit higher than that price in the current market. So it actually really is a wonderful tool to help you keep on top of prices and become a bit of an expert in the market.
The greatest fear every property buyer has is that they will pay too much for a property. Veronica and Meighan discuss that now, and they've got some very good advice to make sure that you do get it right.
And we're back. Good to talk to you again. What we're going to step into the space of now is how to set limits for yourself, that price limit, the amount that you're not going to go past. Veronica, what a property is worth and what you're prepared to pay for it can be two really different things. What are some of the fundamentals you discuss with your clients before they set their price limit for a property?
It's a really good point. We talk about there's objective measures and there's subjective measures. Yeah. There's two objective measures we just talked about. We just talked about actually pricing a property and understanding really where its value sits in the market in context of everything else. And the other objective measure is how good is that property? See, and when you become a local expert, when you really, really know fundamentally what local buyers will go for and what local buyers will, give a wide berth to, then you can know which property you might want to push yourself for versus which one you're not going to push yourself for. So they're the objective measures. The subjective measures are those that relates just to you. So the first one is how unique is that property to you, and in terms of fitting in with the sorts of things that you've been looking for. If you've been looking for a year for a certain type of property and that's the only one you've seen that whole time, well, you're going to push yourself a lot harder than if you've seen three others that you could have gone for. So
scarcity factor, isn't it?
Absolutely.
Yeah, we talk about the scarcity factor a lot.
And then the other subjective measure is your budget. That's the one thing that is uniquely yours. And if you can't spend more than X, then you can't spend more than X. But some buyers do tend to go to auction. I know that I've had this conversation with a lot of buyers over the years that when they go to auction and they've missed out on a number, and then finally when they go to auction and they do buy, and I say, how did you set your limit? And they said, well, I just went with everything I could possibly buy. Like I went with my budget. And I said, did you think
threw the kitchen sink at it?
Yeah. Is it worth it? Is like just because you missed out on those others, did you pull back too quickly on those others, or did you really push yourself to where you should have? So quite often people won't set a limit and then they will pull back when they shouldn't, or they don't set a limit and then they overpay.
Saw an example of that in Brisbane only a couple of months ago. It was a renovator in a really highly sought after pocket, and there were two. Most of the bidders were out at about 1.1, but there were two bidders that had clearly not set themselves a limit. And they pushed each other. It was like ego and emotion, watching each other across the yard, and neither was going to give in. And they pushed up to 1.4 on a property that was worth about 1.1, and that was because they hadn't set their limit, and neither one was prepared to back down.
I've seen that happen too, and I've seen it happen at auction where people, you could see, because usually when there's a couple, the sign, the couple looks at each other
and they think,
they haven't discussed spending more than that.
That's a dead giveaway, that one.
So they're thinking, this is going to be interesting. And we've not been party to this, but one particular auction I remember looking at it, and one couple definitely were over the limit that they discussed before they left home, and the other one obviously were in the same boat. Went up $100,000 in $1,000 bids. Now that's a lot of money to each time, thinking we haven't actually discussed this with each other nor really thought about it myself. And this is what I see is that people go to auction, they go with a limit that is what they'd like to pay, not what they will if they have to.
Will pay. What's their walk away? We help clients arrive at that walk away price by stress testing them prior to the auction. We actually put them in a situation where they have to come back to us at every single rise of $1,000 at a certain level and say, if I ring you after this auction and tell you it sold for X, would you say I would have paid that, or would you say I wouldn't have paid that? And they have to actually do that exercise together to arrive at their, no, I wouldn't pay that number. And that's when they know that they're completely in control of their limit and their decision around their limit.
We do a very similar thing, and we call it pressure testing the limit. So it's very similar in its intent and certainly in the process as well. Because the thing that I like to talk to buyers about is that, you know, if you think you don't want to be emotional, that's all well and good. But the minute you're in the auction and the pressure's on and you're faced with being able to, potentially missing out on that property if you don't continue bidding, if you haven't actually thought this through now, you will, I guarantee, get emotional.
And one of you's not going to be happy if you're in a couple.
Absolutely. You can't avoid that emotion. You can't avoid the argument on the way home if you haven't actually worked through this stuff.
Oh, the total shock of, oh, what have we done?
What have we done?
Look, what underpins a good negotiation is a really good understanding of value coupled with a clear and confident limit. There's no getting around that. When negotiations commence, agents will play on your fear of missing out, your FOMO, and may well try to bluff you. And that's their job. Their job is to get the highest amount of money for their seller.
Yeah.
So having a well-considered, you said it, pressure-tested limit before you start making an offer or bidding at auction is really the only protection that you have against paying too much or pulling out too early.
Absolutely. Now, on that, there's two things. Firstly, if anybody does want to download our free mini course, the link for that is homebuyer.academy/free course. So that's free.
No, it's not. It's
homebuyer.academy.com.au
/free
course.
We'll put the link in the transcript.
And lastly, if you do want to take advantage of that book, that code for 30% off and free postage is RE Talk, all one word, RE Talk. So yeah, until next time when we're allowed the chair.
Again.
With the evolution of social media, marketing of property is no longer linear. Consumers are influenced differently. The Property Show is unique in that it empowers agents to connect with buyers and sellers through personalised content, social media and artificial intelligence. The Property Show delivers personalised, laser-focused marketing by combining new media, social media and audience targeting, and gives the agent a digital voice. See how well the Property Show works, and then let's get started telling the world about your property. See it now exclusively at realty.com.au. Well, we're not going to let Veronica go just yet. Doesn't get off that easily. Because here she is with Eliza Owen from CoreLogic to find out what Eliza thinks might be the impact of federal and New South Wales government support measures for first home buyers to boost the housing market. Here they are.
The federal government has been directing money towards the construction industry via first home buyers in an effort to stimulate the economy. And now the New South Wales state government has actually upped the ante with a temporary increase to the thresholds for stamp duty concessions. Eliza, what effect do you think that this will have on the property market?
I think there will be three main effects for the New South Wales property market. The first is that I would expect first home buyer demand will initially increase, and we've seen that previously around government grants like the first homeowner grant and the boost to that. I think that we'll see prices across New South Wales, particularly for those new builds, probably increase and really start to cluster around the cutoff mark of $800,000, where temporarily we're going to see complete stamp duty exemptions for those new builds. And the third effect I think that we could see is an increase in turnover and construction market activity in the short term. But I think over the long term, we might actually see a bit of a decline in turnover. And I think that that could come from the fact that you're incentivizing first home buyers into larger homes, so they're not having to start small and sort of upgrade later. So I think that in the long term, that could have a bit of a dampening effect on sales.
Yeah, that's a really interesting aspect to it there, that what you're saying then, that first home buyers won't necessarily be starting with the starter property. They're more likely to be starting with that, you know, the family home, which is sort of interesting because a lot of first home buyers do get trapped in that starter property because, of course, if they don't get the capital growth that they require, they get they're unable to sell it and upgrade at a future point. So it's sort of interesting to see how that would play out. I'm interested also in what you said there about prices clustering around about the $800,000 cap. Now, have we seen evidence with the current or the previous cap of $650,000? Have we seen evidence of that happening there?
I think there's sufficient evidence to say that sales were clustering just under 650,000 over the past 2 years. The reason being that initially when these stamp duty discounts were introduced, the exemption on stamp duty for first home buyers was up to that $650,000 mark. So when we saw that introduced between June 2017 and June 2019, basically we saw a bigger gap in the number of sales under that value than sort of above that value. So when we compared that to 2 years after the policy being introduced and 2 years before, there was more of an exaggeration in the sales volumes that were sitting just under 650,000.
Which is quite interesting, because potentially that could mean that first home buyers are actually paying $650,000 for a property that might really be worth $600,000 if there wasn't a real congregation of buyers in that price bracket. And conversely, those who maybe have $670,000 to spend might have got a hell of a lot more value for that extra $20,000.
Yeah, and I think that first point you make is really important, that when we see these kinds of demand side monetary incentives introduced for first home buyers, it can get just added to the ticket price because the buyer has more purchasing capacity if they're not having to pay stamp duty. So that's where a critique of demand side home buyer grants is critiqued as a transfer from the taxpayer directly to the construction industry or the developer or real estate industry, because at the end of the day, it's those who are developing or selling the properties who really benefit from those sort of higher prices.
Very interesting. So what you're basically saying there, that the buyer doesn't get any added value at all. In fact, it's just basically paying for it in an additional price or a levy of the industry, effectively. It's interesting too, because the New South Wales Treasurer came out saying that this is for jobs and for the construction industry. He didn't actually mention first home buyers when saying who the grants were actually meant to benefit. And I wasn't sure if that was a deliberate oversight or a complete accident. You've talked about, or you've referred to the idea of prices rising. So do we have sort of evidence of that specifically, other than sort of a cap? Do we have actual evidence of, in the past, every time a grant's been introduced, there's been an increase?
So what we've definitely seen around the introduction of first home buyer incentives and grants is a surge in first home buyer activity. So I suppose there's the idea that you're not just increasing property prices because you've provided a discount or a grant, which adds to the purchasing capacity, but you're also potentially pushing up prices because you're incentivizing all the first home buyers into the market at that one time after the initial introduction. And I think that's especially the case with this stamp duty discount because it's explicitly only in place for 12 months. Right. So what that's probably going to do is bring a lot of those first home buyer decisions forward to this year. And in that sense, it's benefiting the construction industry because it's saying where we were expecting a paucity of construction or construction to be pretty subdued, here's an incentive that's going to get a lot of first home buyers into the new house and land in a short period of time. And I think that's probably how we're going to see this play out. And we saw the same thing when we saw the introduction of the first homeowner grant, and the boost to the first homeowner grant around the GFC was that the number of secured loans for first home buyers shot up very sharply and then sort of declined and stayed subdued for a long time. So it's an initial sort of shot in the arm for the first home buyer segment, but it's not a lasting answer to accessibility and getting into the market.
Very, very interesting. And I think too, I'm curious to know what your thoughts are. Have you done any modelling to say, well, what would happen if they didn't put in a threshold?
I haven't done any modelling. I mean, it's something that I think if they didn't have a threshold for the concessions, then we would probably see prices more evenly distributed than a kind of bunching at this particular price level. And as you say, that could create more efficiency in terms of a more accurate price for a potentially lower value property, or people spending that little bit extra to get the home that they actually want. So probably worth doing some research. As always, Veronica, you've highlighted some great areas of research that we can do at CoreLogic.
Well, I do actually think the state government potentially should be doing that research. Thank you so much, Eliza. As usual, your insights are fantastically enlightening, and it's great to hear you reporting on this sort of development, because as you know, pardon the pun with development there, but as you know, I'm often advocating that first home buyers take note that these grants aren't for them, they are for the economy, and we want a good economy, but first home buyers need to understand they are the fuel to that economy with these sorts of grants.
There could be more money in your investment property than you realise. BMT tax depreciation finds, on average, between $5,000 and $10,000 in deductions in the first full financial year for residential property investors. They'll work with your accountant to make sure no depreciation deduction is missed. They even provide comprehensive ATO-compliant tax depreciation schedules that last the life of the property, up to 40 years. And their fee is 100% tax deductible. Call BMT Tax Depreciation on 1300 728 726 now for a free assessment of your likely deductions.
Welcome back. You know, it's still amazing how many property investors ignore the benefits of depreciation. As you're going to hear from Brad Beer now, it is never too late. Brad, is it ever too late?
Kevin, look, it's never too late. The only thing I'll say about whether it's too late, I know the tax year's gone, June is over, but you're actually able to back claim for up to 2 years pretty easily and amend your tax returns to go back and get those deductions if you haven't done it properly or you've missed out on some. The thing about being too late is don't do another tax return because that's one that then you would miss out on. Now that 2 years, if you've owned the property for say 5 years, means you can't go back to the start, you can go back to 2 years. So I guess it's too late to get 5 years ago, but it's not too late for 2 years ago. And the important thing is get it looked at before you go and do another tax return in case you don't want to miss out on another year of back claims that might be there.
Brad, you and I have been talking about tax depreciation now for several years, and we always assume that people know what BMT does, but take me briefly through what BMT tax depreciation is all about.
Well, we're the guy that prepares the depreciation schedule. You know, we're a quantity surveyor, and the reason we get involved in doing these is because we estimate construction costs, and these claims that you get to make actually relate to the construction cost of the building. And the tax office says that they'll accept the estimate by a professional such as a quantity surveyor to come up with these numbers to help work out this depreciation claim. And on top of that, we go out, we visit the property, we identify all of the items to claim. We know about cost estimating, but we also know about the tax rules as well to help to maximise that deduction. So we put together these reports by doing all that work and coming up with those costs, and it effectively gives the accountant a number, an amount to claim, a number, well there's a few numbers in it, but an amount to claim for this deduction. And we try to make it as much as we can so there's more cash in the investor's pockets.
Yeah, I said at the opening, it's amazing how many property investors don't understand the importance or what they're missing out on with, when claiming depreciation. Can you give me a benchmark? Is there an average that the average investor can expect to get back?
Look, we've just done, not that long ago, done the numbers on the 19 and 20 on the 20 where we've just ended in June, and the average deduction is nearly $9,000 in that year for the depreciation schedules that we've completed. So that's a deduction of $9,000 on average. That's not the amount of cash the person gets, but it's a non-cash tax deduction. So based on your marginal tax rate, most investors at 37 cents in the dollar, then that's you'll get that percentage of that back. If you're on the higher marginal rate, you'll get the more like the 50% of it back. But yeah, look, across the reports from the year that's just gone, it's nearly $9,000 in deductions. So it's a few bucks.
Oh, absolutely. It all counts. Anyone watching this now and saying, well, I probably couldn't get anything because I didn't have tenants in there for the full year or they left unexpectedly. What would be your advice to them? Is that a fair assessment?
Well, what happens if it's not a full year? It could be for a couple of reasons. One might be that you lived in it for part of that year. One might be that you didn't actually buy it right from the start of the year. Or maybe your tenants left because could have been COVID-related problems or otherwise. You're able to claim depreciation providing the property is available for income-producing purposes. So if you didn't own it then for the whole year, then you obviously can't claim for the whole year. You claim for the portion where you actually owned it. But some of the rules mean that if you only owned it for a small portion of the year, say you bought it and you settled in June, then some of the things get claimed straight away or quickly up front. So it's often quite a reasonable deduction for even that short period of the year. If you lived in it for some of the year, then it gets sort of adjusted accordingly. But if you've got rental income for part of the year, then you want to write off those tax deductions, obviously, if you can. It's just a matter of if it was only rented for 1 week, then maybe it's only going to have a small amount, but you're going to need it if it's rented out at a later date because we project the numbers each year. The other scenario where it might have been because you couldn't find a tenant, could be COVID related or otherwise. As long as it's available for income producing purposes, the same rules still apply. The depreciation and also a lot of your other deductions are still available to you. The thing to be careful of with that, the ATO come out pretty strong with this as we got to the end of the financial year, is if you've actually taken it off the rental market or let someone stay in it at no cost, or it's not actually been available properly for the proper amount of rent or reduced your rent accordingly, then you've got to be careful on the deductions you do make, because it needs to be genuinely available for rent, even if it's vacant. But as long as that is the case, then the deductions of depreciation still stand.
Someone who hasn't claimed depreciation and wants to do so, how do they prepare for it? What sort of information do they need to give you, Brad?
Look, to start with, very simple. With the address of the property, we'd like to have a look and make sure that this property will have enough deductions in there for us to go in and weave our magic that works out how much those deductions are. After that, we'll need to know things like what you paid for it and settlement date, although we'll work that on the way through that process. We need to know who the managing agent is, if you've done any renovation works to the property, and a few questions like that. Then after that, we go out, we visit the property, we go through, we identify and work out what depreciation numbers are there to be claimed.
Pretty simple process. Hey, Brad, thanks very much for bringing us up to date, mate, and all the best.
Kevin, always great to be here. Thank you.
Well, that's it. Thanks very much to our guests, Brad Beer, Eliza, Owen, and another stellar performance from Veronica Morgan and Meighan Wells. If you want to get a copy of Veronica's book, the website is getauctionready.com.au, and make sure you use that code RETALK, R-E-T-A-L-K, to get that 30% discount. We're going to be back next week with more great advice from our list of experts. And don't forget, realestatetalk.com.au, where you can go to see all of our shows. And, you can catch them all, of course, at realty.com.au, the home of property. I'll see you next week.
Real Estate Talk, part of the Realty Media Group. We also produce The Property Show, Real Estate Uncut, and CoreLogic's auction update shows. All available for catch-up anytime at realty.com.au. Thanks to BMT Tax Depreciation, Printforce and Propertyology for their support. Watch out for us in your inbox next weekend, or catch us anytime at realty.com.au.